All right, guys, welcome back to first part, or I guess lesson two. First part was about me. So, second part of our masterclass on how to underwrite deals and how to analyze deals. So, in this lesson, we're going to do something very important. Is we're going to do definitions, and we really need to talk about the important metrics around short-term rentals. The reason that we need to talk about this is because if I tell you how to analyze a deal, we got to speak the same language. So if you don't have the right vocabulary, or if I don't have the right vocabulary, then we're not going to understand each other. So first thing we're going to do is just talk about the different metrics that we need to look at. And I'm going to go through them and define them. And then you can kind of reread this. If you need to work through it slower, that's totally fine. Big thing though is that some of the numbers that you're going to need are not included. So here's what I mean by that is that I'm assuming that you're coming into this course ready to buy, that you have a buy box, which is basically kind of what you've determined you can afford. And I'll do some stuff on that later at some point, and that you've also determined a market or markets that you're looking at, like you're buying in Austin or you're buying in Dallas or something like that. You may be wanting to buy in your backyard or hometown. You might have limited funds. You might have a limited buy box. But once you have those things established, this process that we're doing is going to be the same no matter what. You're gonna run the same types of analysis. So without further ado, let's get into it. Okay, you need to know these numbers, or at least roughly kind of what they're about, so that you can understand the whole purpose of this, so you can understand what is a good property, what is a bad property. And I'm going to define some of those things by talking about cash on cash return. And that is the metric we're using. It's not the only metric, as I mentioned previously. But for us, what will separate a good and a bad property is going to be strong cash on cash performance and weak cash on cash performance. Okay? All right, so let's get in. First term we need to know is gross operating income or gross income. This is just how much money you make. That's that bread, it's that cheddar. It's what you make. So most of this comes from the rental income that you're making for renting it out on Airbnb or Vrbo or whatever. Some of that comes from cleaning fees that you'll make from the property. So we separate that out. There's cleaning fees that you pay for, pay a cleaner to clean. There's cleaning fees that you charge the guest. Most online travel agencies have that feature, so that is a form of income. Then there's other stuff. I actually think that some of the upsells and things, other stuff on properties is kind of the future for short-term rentals, because there's not really much room for us to go up with prices or to go up with cleaning fees. You've kind of maximized that. So really the only way is to acquire more properties, or on existing properties to grow the way that or creatively grow the way that you produce income there. So think about, like, maybe you got goats on a farm, so you sell goat milk, but it's an Airbnb. So you've got other forms of income coming in. Okay. So in the commercial real estate world, this gross income would also factor in something that we call vacancy loss. It just accounts for like vacancy, like you don't have a tenant in an office space for a month or two, but we don't account for that in our gross income statement here, because you'll see later on, it's actually baked in to some of the way we calculate revenue. I'll get into that later though. So short-term rentals, as I mentioned, we handle it a bit differently. We use something called occupancy rate. And yeah, it's for the next lesson. So operating expenses is the next thing we need to define. Well, OPEX is basically the cost to run the property as an Airbnb. So these are any expenses that you have to incur. These are generally more than what you're going to spend on a long-term rental, because long-term tenants usually pay for their Wi-Fi and their utilities. That's a part of being a long-term tenant. For short-term, they are not expected to pay that. And so you have to run those as operational expenses that are going to be deducted from your gross income at some point. So all sorts of things come up in here. You need to get these right. Otherwise, you risk being unprofitable. And I think this is something a lot of people miss, is that they're looking only purely at revenue and their financing, and they sometimes forget that they've got a bunch of expenses that they incur over time. And if they were to look back, they'd go, whoa, this is crazy. I'm spending so much on toilet paper. Why didn't I think about that? So you got to get it right. Everything that you could spend on the property to run it is considered an operating expense, except for your taxes, insurance, mortgage, stuff, which we'll explain the reasons below. Common expenses, things like, landscaping, Wi-Fi, pest control, utilities, things like that. Okay. So when you have your gross income on one hand, and then you have your operating expenses, if you subtract those expenses from the income, you will have what's called your net operating income, or your NOI. This is basically how much income you make after your expenses are paid. So why do you need this number? Well, it tells you, one, how good your property is. It tells you how much money your property makes, and it's a good ballpark number if you're looking for good properties. Oftentimes it's expressed in something that you'll see here called cap rate. Cap rate is simply the NOI, the net operating income, divided by the market value. In our case, we're using the purchase price. And really, it's expressed as a percentage. And so you can see this like on an annual basis, what your cap rate is. And it can more or less help you compare properties like apples to apples. So here's a good example here. And it's used a lot in commercial real estate. But let's say you have a property and it's worth $100,000. And maybe that's what you spend on it. Property 2 is worth $150,000. Both have a net operating income after their expenses. You know, you've got your income, then you've got your operating expenses deducted, then you've got your NOI, and it's equal to $10,000. Well, property 1 is going to have a cap rate of 10%. This is, 10,000 divided by 100,000. And then property 2 is going to have a 6.7 basically cap rate. So property 1 is objectively a better deal. Well, why is that? Because you spent less money on the property and you're getting the same amount of cash flow. So it has a better cap rate. Cap rate is basically going to be the same. If you purchase a property outright with no debt, cash on cash will functionally be the same as your cap rate. But again, I'm getting ahead of myself. Why do you need to know this number? You probably don't, but it's just a great way to compare properties. And in fact, on Strike or on other apps, you can often, that's what you're looking for maybe, is a cap rate, because you might be buying a property outright with no debt. However, most people are buying with some type of leverage. And so debt service is what we need to talk about next. And so I think that this is mostly what short-term rental investors are doing. In fact, it's going to be really hard to nail this one down because your lender is different than my lender, and the type of loans you qualify for and the interest rates and all that is wildly different than mine. It's very common for the short-term rental world for people to talk a lot about debt and about financing and all that stuff. It's very, very highly variable. But there's a few common things, and if you've done real estate at all, you'll know these: principal, interest, taxes, and insurance. So generally, all these are bundled up and escrowed with your lender, and so we don't include them above in our operating expenses because they're actually thrown into they're escrowed into your mortgage account. So that's why we don't include them. So what you'll do at this point, so we have our gross income, we have our operating expenses. We've taken those operating expenses, subtracted that off the income. That gives us our net operating income. Then we're going to take that and we're going to subtract our debt service. So once we've subtracted our debt service, we will get this cash flow. So cash flow is what is important for you as a short-term rental investor. How much money can you make in any given period after all your expenses and debt service is paid? We express that in two ways, just as a net cash flow number, like I made $500 this month or $500 a year. That would be abysmal. I wouldn't buy that property. But cash on cash is just kind of it's a percentage expression of that net number. So, but it's expressed as a percentage of the total cash that you've invested. So it's a really important metric because what it basically says is how much money you put in to start the deal. It's a percentage of how much of that your rate of return to recover that. So if it's not making sense, it will here in a minute. But what you're going to be doing is you're going to be basically looking for properties based on their cash on cash, their percentage return. And so let's just do an example for you to understand it, because the higher the cash on cash, the better. So let's look at these examples. Case 1. Let's imagine that we did buy that property above, and we now have two options. The first one is we can just buy it outright with all cash. So we're going to buy a $100,000 property. We're going to spend $100,000. Our NOI is $10,000. That means our cash flow on a yearly basis is $10,000. And therefore, our cash on cash percentage is 10%. So if you're doing the math, $10,000 is 10% of $100,000. So our cash on cash is 10%. So in that equation, how many years is it going to take you to make your money back that you invested in? Well, it's going to take you 10 years. What about case number 2? Let's assume instead of buying the property all cash, we leverage. We put 20% down. Instead of paying the full $100,000 outright, we only put 20% or $20,000 down. And for the sake of example, let's just imagine we didn't have any additional costs out of pocket. No costs out of pocket. So our cash flow after subtracting our debt is going to be, let's just say our debt's $3,000. Our cash flow is $7,000. Well, what this means is that your cash on cash is actually 35%, 3 times higher than in the first case. Well, why is that? Well, we only put 20% down. We only spent $20,000 out of pocket, and we're making $7,000 a year. So really, in just shy of, or just over 3 years, theoretically, this property would be making back all of the money that we spent on it in the first place. So you can see the power of leverage and of debt when you look at cash on cash. It's important to state, though, I can't tell you whether you should be comfortable with debt or leverage. I'm not Dave Ramsey, and I can say that leverage is very common for short-term rental investors. And I assume that if you're watching this and if you're taking this course, you're probably considering that as an option, at the very least as an option. And rather than try and dissuade you from taking it on, I might as well equip you with knowledge that might help you, just so you have like that information. Okay. So in this next section, we're going to be focusing on what is a good cash on cash. As I mentioned to you, we need to understand what cash on cash is and how we get there. But now that we understand it, I think we need to talk about what a good cash on cash is. And I think a good cash on cash is anything close to 20% or higher. So let's think about it a little bit more. You see this chart here. If we were to have a negative cash on cash return, that means literally you're paying money each month to own this rental property. And so here would be my question for you. Do you have some other reason to buy this property? Are you sure that's a good reason? Does it seem rational to you? Because it's probably not rational. So there's emotional reasons to buy a property. Maybe you just really want a vacation property in the Smoky Mountains. And so you bought a deal. You don't care if it's a good deal. You just want it. Well, that's one type of purchase, but it's not a good short-term rental purchase. Excuse me. So for our purposes, we are just going to eliminate that left column, that negative to 0% cash on cash return, because if you're seeing that, it's not a good deal. Like, why would you buy it? But let's go to 0 to 5%. Let's say you find a property and it's producing 5% cash on cash. Well, now we got some thinking to do. And, if you think about it, treasury bills with the U.S. government are right now like 4 to 5%. Why would you not just buy one of those? If you're going to get a 5% cash on cash return, why not take that $100,000 you're going to invest and throw it into a treasury bill, knowing that it's guaranteed money over the next 6 months to a year? With the rates where they are, it's the safest investment you're ever going to find. So why would you risk it to put it into a property that's going to require substantial work? It's going to require some additional risk and some other things out of pocket. It really comes down to, do you have another reason to buy this property? Is it worth the risk to you? So generally, I'd say stay away from these because there are safer instruments that de-risk your money and that you don't have to worry about the return. Now, certainly there are other reasons to buy properties, but what I'm trying to say here is that there's an opportunity cost that comes with that money. So let's go to the middle here, 5 to 10%. Well, if you look at some of the market rates on, some funds that are out there, they're like between 8 and 10%. And so one of the questions you'll need to ask is like, if you're finding something in the 5 to 10% range, how is this property better than the market? So maybe you do think it's better. Maybe you think things are kind of iffy right now with financial markets, but for some reason real estate is immune to that, and you think maybe you'll do a better job than the market. Okay. Well, now the one thing we need to talk about is the net cash flow. Like, is it actually worth it? Let's say that you're doing 10% as a cash on cash return, and that was $100,000 invested for our example. So you're making $10,000. Well, you need to really weigh the cost of your time and how much time you're going to be spending on the property, working on things and getting it ready, or kind of running it and operating it. Is it worth it to you? And then I also think you need to be asking, is there another reason to buy this property? Because at this point, it's going to be a lot more work. There's other options for you. And certainly it's looking better than a treasury bill, but this one is kind of like you really got to think about it. Next on the list is this like second to right column, this 10 to 20%. So now we're getting into the green zone, because if it's after 10%, you're already mostly beating the market and on other investments that you could make. Maybe not crypto, but that's beside the point. It depends on the year probably and the cycle for that. But here's one of the questions that comes down to for me. What's the net cash flow? Is it worth the cost of your time? For example, if you can cash flow 10% on a property, but let's just imagine that 10% is like, let's say it's a super cheap property. It's like $50,000 and 10% is like $5,000. You're really making something like $400 a month. And the question really becomes, in my view, how much time are you spending? Are you spending 20 hours a month on your property, 45 hours a week? Because if you're doing that, I got a news flash for you, is that you could make just as much money working at Chipotle. So why not just go work at Chipotle? Because you're going to make just as much money and it doesn't involve all the risk and all the headache. So you just kind of have to weigh that. So if the cash flow is good, it could be lower, like, 20% of a $100,000 property is $20,000. 10% of $1 million property is $100,000. So we're talking, you just need to know what the net cash flow is what I'm getting at. So this area is more in the green zone. We're going to look at it more deeply. And then anything over 20%, it's a no-brainer to me. It's like, where else are you going to find that as far as real estate goes? So to me, it's obvious that the sweet spot is closer to 20. So that's what I'm going to be teaching you to do in the rest of this course, is how do you analyze a deal and get it close to 20, or look for opportunities close to 20, as close to 20 as we can get. Now, speed and doing this over and over and over again gets you some practice, gets you faster at it so that you can do these a lot. You can do a lot more of these to find the right deals. Or, as I mentioned before, you can use my app, Strike, STRIQ.com. It'll do it for you in the palm of your hand. But let's go ahead and go to the next lesson, which is actually putting it all together and analyzing a deal.